Hey everyone, if you're here today, it means that you're passionate about driving financial services to your whole population in the country, whether you're a regulator, a Ministry of Finance official, a community sort of member of one of the banks or one of the providers of financial services, or maybe you're just a curious technologist or a curious citizen that wants to see how to drive financial inclusion. Now, financial inclusion is critical because it's the key driver, one of the key drivers for economic growth. Whether it's the access to credit or the ability to save money so that you can actually build up a set of savings in case of shocks, whether you can have access to insurance products that can support you in the case of a health emergency or a car crash or some sort of natural disaster, whether it's sort of government benefits that are reaching people. I think this topic of financial inclusion is something that is critical for any government or private official to understand if they're curious about driving economic growth. The problem is that when people think of financial inclusion, it's a very big sort of sector or area, and we think it sort of can be broken up a little bit better to be able to understand how to achieve it as a goal. And as a goal, when we think of financial inclusion, we think of access, we think of engagement, we think of affordability, we think of quality of services. So I would say actually those three are the critical. Access to a service, to a set of services, the quality of those services, and the affordability of those services. Now, how do you get to these three? And the traditional approach is to say, okay, I can design a big sort of government program that drives credit to the poorest, for example, right? And these are typical financial inclusion efforts, which would say, all right, I can bring some banks together, I can subsidize the loans with a credit guarantee, let's say. I can do interest subvention. I can have, bring some banks together and ask them or open a new bank branch sort of in a rural or remote area so that you can access, so that the people in those communities can access bank accounts or things like this. Normally, the efforts for financial inclusion are very supply side driven and they're orchestrated by bringing some players together and requesting them to make an exception, right? And requesting them to do something that might not make sense for their business model or changing their business model through a government intervention in their cost, right? Which is what an interest subvention is. It says, look, a bank wants to give a loan, I will reduce the cost of that loan. Now, the DPI approach or the digital public infrastructure approach has been sort of quite successful in actually crafting scale-ups in financial inclusion to an unprecedented degree. And the way that this happens is not by bringing together just a few actors and mobilizing their ability to solve something, right? It's not about creating a new bank branch, just a bank branch in a set of villages. It's actually through these two goals. It's through unbundling, which is to say, okay, financial inclusion is a big part of the puzzle. How can we deconstruct that into many different separate building blocks that are required? And second is through this idea of cost reduction of market players. So rather than bringing market players together and saying, can you please make an exception? You ask the question, what is preventing market players today from solving those challenges and solving those goals? Because there are many market players today, whether they're publicly owned banks or privately owned banks, a series of private fintechs, or a series of insurers, a series of investment advisors, a series of an ecosystem for investments. Financial sectors are often the most active and engaged sectors on the market side. Yet what ends up happening is you try to ask them to make exceptions rather than asking what's blocking them systematically. So the DPI approach is about saying, can we identify what their costs are, reduce their costs, and improve their ability to innovate, to make sure that everyone is included, that access is universal, that quality is higher, and that affordability becomes a reality. So this is the first sort of paradigm shift, to go from bringing some market players together to make exceptions, over on this side to asking what all market players have in common in terms of common barriers and unlocking those barriers systematically. So I think this is the broad sort of picture or idea. But practically speaking, what does it mean? I think a second mistake that's often made is when sort of there's an effort to bring together a bunch of players and say, can we create a credit program that will work for MSMEs, right? They have a solution-driven approach to the problem where they try to put everything together into one program. And realistically, that doesn't work because of the infrastructure required at each stage that's not actually fulfilled. Rather than trying to go solution first and to say, can we launch a lending app and hope that that app will solve, you have to ask, can we build infrastructure and then have one app that will use and combine many of these infrastructure in order to be sort of a winning implementation or a successful product that becomes the flagship of that group of infrastructure. But the infrastructure might be run, operated, managed by many different entities in the country, and that's critical, right? To think of this as a national fabric and not as the initiative of any one government department or any one bank, even if it's the largest in the country. So when we say, how do we break this down? There are probably three major stages that we'd like to think through in terms of financial inclusion. The first stage is enablement, right? If you think of the goal, it's to enable people to enter the formal financial system. Most people are still, outside the formal financial system. They're using informal methods of interacting with their peers. They are sort of saving cash under their mattresses. They are creating informal, groupings for credit unions that are not protected by the laws and regulations that have been put out by most regulators in economies, right? So enabling someone to first enter the formal financial system is the first goal, to say, do you have an account? And that's why most of the financial inclusion surveys, such as the one done by the World Bank Findex and CGAP and others, they track the percentage of people in the country that have any kind of account, right? So that's the first sort of piece to say, the stage one is, can I bring most of my population into the formal financial ecosystem? That's enable. The second stage is engage. What this means is now that they are inside the formal financial system, can they use the formal financial system for their day-to-day transactions? Which means, can I, pay somebody on the street as a merchant? Can I pay my friend? Can I receive my salary? So some of these income and outflow costs should be as part of the formal financial system, and that's the engagement sort of block. The third block is sort of empowerment, which is to say, can I access a financial service that will improve my quality of life, right? An additional service. So if you think of engagement as me paying, to buy tomatoes on the street, empowerment is, can I access a credit product that will allow me to invest in a new opportunity, right? Or to build my own small one-person business, right? Or can I access an insurance product that will protect me in the case of a health, a health incident, or in case of a home burglary or a fire or a natural disaster? Can I invest some savings that I've already put together into sort of an instrument that will give me a small return? I think the empowerment bucket is sort of often tackled first without tackling 1 and 2. This is not to say that these should be chronological, but it's just to say that they should be thought of separately, right? So now if we try to double click into what does it take in terms of your goals for what you achieve in the enablement, engagement, and empowerment bucket, when you enable individuals, they should first, or the indicators, when you enable individuals, they should first have an account. That's the first goal. The second is they should have funds in those accounts, right? Of course, if there are no balance accounts, then they restrict the ability of the individual to use it going forward. And those funds into those accounts are often, the first depositors happen to usually be government social benefit or those kinds of transfers. So I would say the first enablement is, do you have the targets, or do you have an account? And are there a baseline small amount of funds in that account accessible to you in digital form? The second bucket on engagement is the goal or the target to track the indicator would be payments, right? So payments, are you able to transact to my peer, P2P payments? Are you able to transact to a small merchant, P2M payments? Are you able to pay your recurring bills, which is bill payments? Are you able to pay tolls if you're traveling, which is toll payments? All of these are sort of indicators of success in the engagement bucket. In the third bucket of empowerment, the goals would then be, are you able to access a loan? Are you able to access insurance? Are you able to access investment? So these are sort of the goals of the types of financial products you should be able to access. And now there are N variations of these. They are small ticket versus large ticket. You know, they're a recurring credit line versus a one-time personal loan or a one-time business loan. In fact, they're cut by different populations as well, business products versus individual, etc. But the way to think about this from a DPI perspective is, now we have to ask, what is the infrastructure that when put into place reduces the cost for a financial service provider to actually offer that service, whether it's a bank or a community bank, a collaborative bank, which are in some places also credit unions, or any other kind of financial service provider. What is the building block and how do we unbundle it so that it is as minimal as possible and put into place across many departments and institutions? So if we have to unlock this row, which is what are the DPI building blocks required towards each of these goals, we'll get an understanding of how to drive up inclusion. So first, let's talk about the enable block. So remember, the goal here is to access an account, to be able to open my first account. The target audience here is usually the poorest of the poor who have been excluded from financial systems until now, formal financial systems. And if you look at then why has the market not solved for them, right? The traditional answer has been, okay, we'll solve this by sending banks to villages or rural areas or remote far-flung areas and to open a branch there. Unfortunately, that's not a cost-effective intervention, right? And it often asks banks to actually change their sustainability and profitability in order to make that happen based on some pressure from officials outside to drive inclusion. Now, the real cost issue here is to ask, what is the cost of opening an account? Most of the cost actually ends up becoming in verification of identity, right? And we found that almost 18-20% of people who don't have an account, as per the Findex survey, had cited that it was due to a lack of identity documents. So the core infrastructure that you can put into place to actually accelerate bank account opening, the first one is actually electronic identity authentication and electronic KYC. What do we mean by this? It means that for both an individual and for a small business, are they able to prove 3 or 4 basic data fields about themselves to a financial institution at low cost in a reliable manner, where the financial institution can quickly open an account? We've all been through the experience of walking into a bank, in a new country and trying to fish out the series of documentation they require to open the bank account. Whether it's, if you're going to a foreign country, you have to show your passport. If you're within the country, you end up having to show your birth certificate or your voter ID or your national ID or your resident ID, any one of these identities. The DPI building block that's required to actually enable account opening, we found, is the ability to do electronic KYC. Now, this electronic KYC is sort of implemented as an API typically. What that means is that you should be able to ping any bank in the country that seeks to open an account, should be able to take an identifier number or an identifier ID and to ping the department that has issued that identity. And that department should be able to revert to the bank directly a set of 3 or 4 minimum data fields as per prevention of money laundering rules, as per the KYC norms in the country, the minimum few fields required to actually open an account. And this piece has been most successfully implemented in a number of countries that have built an electronic KYC API. One great example is, again, that of India, where the use of Aadhaar electronic KYC over a period of a few, I would say 8 or 9 years, was able to actually accelerate the share of bank account ownership from less than 30% to above 80%, and actually close the gender gap in accounts that have been opened to the point where men and women had equal likelihood of opening accounts. Now, the infrastructure for this that drove it was the ability to authenticate an identity that provided the few data fields that you need to open an account. It's important to note that this infrastructure can be introduced through a pure online manner, which is the electronic KYC API, but it can also be introduced in an offline friendly manner, so that in areas with rural contexts or without connectivity, they can sort of access a verifiable credential that allows them to do a QR code scan to get an identity confirmed and then take details down. So whether you choose to do electronic KYC in a fully online manner using an API, or whether you choose to do it in a hybrid online-offline manner using a verifiable credential that's been issued by the department that has issued the identity, either works. You have to just have it in place, and often there is a lot of pressure on central banks, in fact, to reduce their KYC norms and to kind of make inclusion happen. But the reality is there has to be a balance of the right norms that protect against money laundering and the right digital infrastructure to provide identities that meet those norms. Both the regulatory and the policy side here, both the regulatory and the technology side here are critical to sort of take this ahead. So that's, if you do electronic KYC and verifiable credentials right on the identity side, you will have built a building block for an individual to be able to open an account seamlessly, right? And that's the technology infrastructure. Now, as we always say, DPI is technology plus governance or policy plus market, right? The technology side might be the electronic KYC API or the verifiable identity credential of any existing identity in the country. The governance side or the policy side might be an edit of the KYC norms to create a no-frills or a very small zero balance account that has a lighter KYC requirement, which is already the case in many countries thanks to works of the FATF, the Financial Action Task Force, which has put out norms around financial inclusion and a recommendation to central banks to consider norms for those that are excluded. And the governance side might also involve some sort of orchestration across the existing financial sector players, not to tell them to make an exception, but rather to leverage newly created infrastructure. So it might require on the governance side something like convening the banks and saying, look, these two identity verifiable credentials or authentication mechanisms are being made available. These are the identity authentication mechanisms for individuals. It could be a national ID in the country, it could be a voter's ID, it could be a driver's license. Any of these can be made sort of verifiable. Argentina, for example, has a verifiable driver's license that is used for KYC, and many other countries have their own versions for this. Or it could be for businesses where a business identity, which might be my business tax ID, my business registration document, my company incorporation document, or my sole proprietorship or MSME as it's known certificate or credential, which exists in many countries. For business account opening, these documents would have to be made available. So both of these, once they're made available, they form the foundational bedrock for enabling access. And we believe that this DPI approach works much better at driving up the number of accounts that have been opened in your country or that people have access to, giving them enablement to engage with the financial sector. The second building block on the enablement side might be putting in the first round of cash into that account. Now, many of the poorest of the poor that are excluded from the ecosystem may not have cash that they want to deposit immediately into their account. And so the way to kind of drive this forward is to think through, okay, in addition to the account opening, what incentive or what mechanism can I offer that will get people to build their first trust relationship with this new account that's getting opened? The reality is that most people that have never used a bank also don't necessarily trust that institution yet, and so would have to have some mechanism to incentivize them or to to nudge their engagement with that system. And often the most effective mechanism for that is benefit transfers or social security transfers that are done from the government to the most vulnerable communities. These might be pension transfers to elderly people. These might be benefits directed to women or children or new mothers. It might be benefits directed to those who are unemployed. It might be benefits directed to those who are in certain rural communities or certain kinds of workers in specific sectors, etc. The key, again, DPI building block here is how can I make this government transfer very effective and low cost, right? How can I transfer money to one of these identifiers, let's say, that you've already created in your electronic KYC or verifiable credential drive? And the key sort of DPI building block there is what we call a government-to-person account mapper, which will allow, it's a very simple 4-field registry that can be housed by any payment operator. And it allows for any government department that is trying to transfer money, or indeed any private agency as well, but you can start with government departments as the users, to simply collect the ID number from the individual and use that registry to route funds to that ID number without collecting any additional information from the individual about their bank account, their destination financial account, their mobile money account, their mobile wallet, or those kinds of details. It prevents a lot of repetition across departments as well. So these are probably the 2 key building blocks that help enablement, which means can somebody just first enter the financial system if they've been excluded and interact. So by now, if you've built the first set of DPI building blocks that will enable people, that will allow them to enter the ecosystem, the next step is to engage, right? What do we mean by engagement? It means transactions. How do they transact regularly? And digital payments, is not a new thing. It's been around for a long time. So what is really the DPI approach here? Is it even required? Can normal existing digital payments ecosystems continue to thrive? What we believe is that today there are many digital payments solutions that tend to crop up, right? The problem is that they tend to crop up in silos. So you'll have, let's say, a separate mobile wallet, mobile money ecosystem, where each telco provider will be running their own mobile wallet and not be able to be interoperable with the rest of the banking system or with other wallets. You have a separate cards set of schemes where you have, let's say, your Visa, Mastercard style, American Express, etc. ecosystem where those schemes again are not interoperable with the wallets. And then finally, you'll have some bank-to-bank transfer ecosystems, which are like RTGS equivalents, real-time gross settlements, or ACH type payments, right? Automatic clearinghouse type payments, and the new innovations of that, so real time. What we think is happening in the payment space is that, irrevocably, everyone is moving towards instant, right? Instant is no longer in doubt or in question. Instant is an inevitable trend. But instant is the first thing that you require. It is necessary, not sufficient, right? For digital payments to operate as a digital public infrastructure for the country, you need payments to be instant, but also to be inclusive. That means anyone can access it in the country, regardless of who they are, and also interoperable, which means that they can choose any store of value account and use any sort of device or mode of making that payment. You need all these 3: instant, inclusive, interoperable. So how do you get there, right? And this is, the payment rail sort of discussion to unlock. How do we get to these 3? The question is in crafting the right network or ecosystem that will allow for market innovation to take off in payments for all these 3 to happen. For example, in interoperability, you should ensure your payments rails are usable regardless of the kind of account, right? Regardless of which app you're sort of using to interact with the payments ecosystem, regardless of who the recipient is. So, in many ecosystems, you have the equivalent of a different rails for me to pay a merchant, which is, let's say, through a card, versus me to pay my friend, which might be through a bank transfer, versus for me to pay the government, which might be through some electronic filing sort of system, right? So it has to be interoperable across any account, across any app, across any recipient, but also across any device or any mode, which means that it should be usable, online or offline. It should be usable in areas with no connectivity and with connectivity. It should be usable via a QR code, and it should be usable if I just know the mobile number or the payment address of the person. It should be usable if I can sort of use my feature phone, which might not be my smartphone. It should be usable in self-service mode, which means I make the payment myself, and also in assisted mode. This is what we call ambitious interoperability, which is a much higher bar than the traditional questions around interoperability. So to build a digital public infrastructure approach into payments means to target all of these. But how do you actually get to this outcome of instant, inclusive, interoperable, of this unified of this diversity? The key is to actually, again, craft and think through the roles in the ecosystem and see who can provide that innovative role at the top that will create that diversity of experience. Who will build the best payment app? Who will build the voice-based payment initiation experience that can be used on a feature phone in a rural area, right? Who might build the touch and pay, but at a low cost, so that a farmer in an area can use it to tap and pay, even if they don't have a card, right? Maybe they can do a tap and pay sticker that can go on the back of their feature phone that can be used to initiate that payment. That layer of innovation has always been a question for digital payments, is who will unlock it. I think the key to the DPI approach to payments is to say, let us unbundle the roles in the financial sector so that you handle this constant tussle between banks and fintechs, right? So what is the story of every financial sector? You have banks which have been around for 30, 40, 50 years. And because of the legacy institutional architecture, banks often do not feel most comfortable in driving the latest technology apps because they are designed to protect consumers from risk, right? They are not designed to be the most innovative on the newest cutting edge product. By their design, they are intended to be middle stage adopters, not early adopters of technology, because there is too much risk. If something goes wrong and a bank is held liable, then you don't want your bank to be taking those risks. You want your bank to keep your money safe, right? But we do still need in an ecosystem a degree of innovation that will allow for new types of actors to build new user experiences that will allow the last mile to engage in payments, but in a safe and organized manner. And the DPI approach to this, again, is to unbundle the roles of different actors. So at the bottom, you would have the roles of banks, which is the traditional role of moving money. That role should not leave the banking sector, in our opinion. But the DPI approach might allow for you to separate out and say there might be a role for fintech innovators to only play the role of moving, of the experience of moving money, not the fact of moving money. What does that mean? It means that you should be able to allow any fintech app to actually initiate a payment transaction through a variety of means. It might be through a feature phone, it might be through their smartphone app in a local language, it might be through a voice-based initiation in English, it might be through a tap and pay, it might be through an automated instruction that they've put on the fintech app. But the initiation of payment can be done outside of the people who are responsible for keeping your money safe and moving the money. The key thing is, in many countries, both of these roles have become blurred in a new class of institutions, which might be sort of the new age banks or the new age wallets, right? The problem with that is, once these fintech ecosystem folks start playing in the role that the banks see traditionally as their role, you start to see battles between these two rather than cohesive cooperation. And as an ecosystem orchestrator, our approach to framing a DPI-led transformation in payments is to request to clearly architect roles and clearly architect your specifications, your payments protocol, your standards for communication between these two entities, so that you can actually initiate a payment outside of the banking ecosystem for an account that you have within the bank. It doesn't have to be a separate fintech account or a fintech store of value. There is no store of value at the experience layer. You can trigger that instruction. The banks can move money using a switch, right? And the experience of completion or authentication of the payment can also be taken at the fintech experience layer. And this is critical. Many countries have triggered an initiation of payment, but not a completion of payment at the fintech layer. But we believe that the innovation potential or incentive is much higher for the fintechs if they can actually have the customer from start to finish of the payment transaction, not simply initiate the payment and then route them to a bank, right? So if they can have access to some sort of standardized, secure form of payment authentication, such as a PIN, right, or any other form, then they can actually complete the whole experience layer while the movement of payment stays in this sector. So what this does is it unlocks market innovation to actually create many different user experiences for payments as per a common network that is designed to account for any type of payment. And the beauty of crafting a DPI approach in that way means that you can actually solve for everything from paying my local tender coconut vendor on the street using a QR code that they have just as a sticker, which is the lowest cost way to bring them onto digital payments, versus you could also have me going into a retail shop and paying for a new television with a credit line, right, which is a completely different type of account, using just my mobile phone as the instrument instead of trying to access or procure a credit card or some other loan that is sort of use buy now, pay later as it's known, right, in this ecosystem. So many different types of payments can actually be encouraged using a common rails, as long as that rails, the technology rails, has been designed in a way where it's any account, any app, any recipient, any device, and the regulatory landscape has been framed, the market ecosystem landscape has been framed so that banks do what they do best, which is manage and move money, and innovators on the fintech side can do what they do best and design creative user experiences without putting your money at risk, right? So overall, if you're able to craft a payments ecosystem that can actually be inclusive, instant, and interoperable, the powerful second order effect that you get on your economy is a generation of granular data. And don't underestimate the power of this. Many of us think that the value of digital payments is convenience, right? Is the ability to do remote transactions and e-commerce, which is all true. These are all first order effects of having a digital payments rails in your ecosystem. The second order effects, though, are the fact that because you have an ease of transactions, first of all, it triggers increases in consumption and spending, which drives up your GDP. And second, it actually allows for more granular data or information held in the formal financial system of transactions that used to be dark, they used to be cash, and therefore the banks had no visibility on this kind of history. The generation of that kind of history is actually what drives you to enter the third phase of empowerment, of access to services, because now for the first time, a bank is able to look at a customer who might be a small shop owner in a rural area and say, I know your history, I know your spending patterns because they're in your bank statement for the first time. What used to be you drawing cash once a month and depositing cash once a month is now broken down into granular income and expenditures, which I can use to better assess you for small ticket loans or small ticket insurance. And so therefore, now we can move to thinking through, once you have the ecosystem for enablement and engagement, what is the DPI ecosystem for empowerment or access to financial services? All right, so let's say now you've built your digital infrastructure for enablement. You've brought people into the financial ecosystem. You've built your digital infrastructure for engagement, which means they're paying and transacting regularly. This still isn't financial inclusion, because the true goal of financial inclusion is to say, Can a person access a loan? Can a person access insurance? Can a person access investment? For these three major goals of can I grow, can I save, and can I protect, right? Can I grow in terms of opportunities, in terms of sort of new endeavors that I might need money to engage with, like a new business opportunity that I need a loan for? Can I save, which would be essentially to be able to continue to accumulate my savings to support me in times of distress, and to accumulate my savings in a manner that gives me interest, which most people who are storing their cash are not able to access. And finally, can I protect, which means can I be protected in times of risk or adversity. Now, to get to these outcomes, the question then is, what is the critical building block on the DPI side that can power access to credit or access to insurance? And this is where, again, to repeat, the typical approach is to do an interest subvention or to do a credit guarantee scheme, right, where some ministry or official says, I will guarantee your risk if you go out and give loans, right, or to say, I will reduce your interest rate. And again, these are not sustainable over the long run. They require a huge amount of government, investment in those kinds of projects. And while they may be good catalysts to kick off effort, it will not sustain without the infrastructure. And so therefore, what is the digital public infrastructure for access to these services? And drum roll released, we think it's data sharing. Because the core of the function of what's happening when you get reviewed for a loan, when you get reviewed for an insurance product, is actually the ability for you to prove your worthiness to be able to pay back or to engage in the financial transactions of that loan. So when you apply for a loan, they're assessing your past history and your future potential, and they're assessing information that they can access on that in order to see whether they can approve you for a loan. So the simplest and first principles response to how can I increase credit penetration is to solve the information gap that exists between me as an individual who knows that I would be able to repay a loan of X and the institution offering the loan, who needs to evaluate whether I can repay the loan based on the information that I provide to them. So that's why we believe that data sharing is the critical infrastructure to craft that will actually drive up access to insurance or credit as a primary sort of goal of financial inclusion. Now, what kinds of data are we talking about? The data sharing is a very big and broad term, right? There are typically kind of two types. The first is sort of personal data, which means this is information about me. This is information about my past that I'm not sharing with anyone else except for the institution who might offer me a loan. This is things like my bank statements, my land or property ownership documentation, my tax filing history that might be useful for a bank in order to approve me for a loan. But the second type that we also think is important is public registries. And typically the way to think of it is personal data is usually about your asset information. What do I have and what do I expect to have? Such as your bank statement, which tells you what you've had in the past, and what you expect to have might be your future cash flow information, like a salary slip or a future invoice that you might be expected to get paid on as a business. And the registry side is the liability side, which is to say a public, let's say, credit registry or a credit bureau, which often exists in many countries, that can real-time keep track of who has taken out a loan elsewhere in the ecosystem. That's a useful check and balance for a bank to sort of review at the time of a loan. Now, the traditional sort of approach to both of these are not new, right? Today, personal data sharing happens all the time, where I print out my bank statements. I have to go notarize them usually for trust so that they know that I have not messed with it, and that notary is signifying that these are the bank statements as they are true. And I go over and take the bank statements physically to a loan office and say, look, this is my past information. Can you give me a loan based on this information? Personal data sharing is a ground reality today. The question is, how can we reduce the cost of that data sharing and increase the trust, right? How do we do it in a way that the banks can actually review it's cost effective for the bank to review all of the documents needed to even approve a very small ticket loan, which is how you might get inclusion to snowball. Because the bottom of the pyramid is not going to walk in to a bank branch and get approved for a large size loan on their first try. They simply don't have the history. But the way to, again, have baby steps into their inclusion is to say, okay, can you make it feasible for them to access a small ticket loan? And to do that, you have to adjust the unit economics of that loan for that institution, and that means solving for the cost of their data review process, right? And the trust with which that data review is done. So for personal data sharing, our main approach, again, this breaks down into two categories or two types. One is verifiable credentials. If you remember, we talked about verifiable credentials back in the electronic KYC bit when we said we want to be able to create a verifiable credential for your identity, right? To say I am who I say I am and to prove that to an institution. Similarly, you need to create a verifiable credential for I have what I say I have, which is, let's say, a verifiable credential for a land ownership document, or a verifiable digital credential for a home ownership document, or maybe cattle ownership, or a bike ownership, or two-wheeler motorcycle ownership. These kind of asset ownership documents should be available to banks in a digitally signed and machine readable format. And that allows for them to actually review this at a low cost. They can just plug it into an algorithm in terms of the response and evaluate the value and the worth of that property and use it to assess the credit worthiness of the individual. So verifiable credentials are one important digital public infrastructure to put in place for personal data sharing. And it's crucial to start with the assets that are used most commonly for the bottom of the pyramid to access loans, such as, let's say, a home ownership document or a land ownership document for a set of farmers and beyond. You have to think through this within your country to say which documents are actually realistically used. Is it a motorcycle? Is it home? Is it land, etc.? The second category is for a higher volume and fluctuating transactions that reflect my history. So anything like a bank statement, anything like my insurance or mutual fund statement, something that indicates my series of transactions that I've had with an institution, my series of tax invoices, my series of, transactions within my bank account or my mobile money account. And this ecosystem is commonly referred to as the open finance ecosystem. So this is the ability of me as an individual to share my history from institution A, let's say bank A or mobile wallet A, to bank B or lender B that might review that information to be able to approve me for a loan. So that is often an ecosystem that's crafted based on the ability to have a digital public infrastructure for consent, for me to provide consent in a trusted, in a granular, and in a revocable form. And it also relies on the real-time APIs or data sharing pipes that will allow for the data to flow from one place to another, second. And third, it would rely on a standard for financial information, which is usually required for the person on the other side to actually consume and understand what they're getting through the pipes. So those are the three major specific building blocks on the DPI side for personal data sharing on the open finance side. And of course, we have verifiable credentials and the ability to issue verifiable credentials for any asset information. Meanwhile, if we've covered personal data sharing DPI building blocks, the next one is to take a look at registries. And this one is actually the simplest in some sense to implement, because although bureaus have existed for many years and decades now, many of them don't share information in real time and don't update information in real time. So what's required is to look through the bureau ecosystem and to introduce real-time APIs for them to actually ensure that they are up to date in their record of who has a loan where. And this is increasingly important as the duration and the size of loans shrinks because of the infrastructure you've put in place. Now, maybe if you just had people taking formal loans once in 2 or 3 months, or maybe twice in their lifetime in large ticket sizes, it's not so important to have a registry that's up to date every week, because it might not be changing every week. But the moment you introduce infrastructure that makes it cost effective for a bank to actually offer a loan that is a small ticket, maybe like a $2 or a $10 or $20 loan, it's likely that the repayment period is also going to be short. So by the time they've taken the loan and repaid it in 7 or 8 days or in 2 weeks, your credit registry might be out of date. So this is why now it's an increasingly important push to make sure that credit registries, in order to maintain the stability of the financial ecosystem, are using open APIs. And if you cannot sort of get the bureaus in a country to adopt a common set of open APIs, it might be powerful to create a new public sort of credit registry that actually gets this information from banks and requests the bureaus to focus on analysis of the data rather than on just the pure fetch of the data, which is just a plumbing exercise. But let's say you've built data sharing. Is that sufficient to actually scale up the empowerment bucket? We would say data sharing is the most critical piece to unlock, that if you're able to create an infrastructure for data sharing, it allows for a bank to, let's say, review your documentation at a lower cost using a series of algorithms without physical visits to the branch office to verify your identity, to verify your your history, to actually verify your assets, right? But it might be necessary, not sufficient. And we would say if you want to actually sufficiently close the loop on credit, you have to think through the additional probably 1 or 2 steps and the infrastructure that's required for those. One critical one that's often missed is actually signature. So you can all think of a situation where you've actually submitted, imagine you've submitted all of your documents for a loan, you've submitted the data from a variety of different sources, you've actually completed your electronic KYC, you've even used your payment rails to set up automatic repayments on the loan, which is an additional infrastructure you can build to enable lending. But the final step, imagine if you had to go physically in order to sign or agree to the terms of the loan, right? And this would be fully counterproductive and counterintuitive. It reduces the impact of the other infrastructure that you've built. So another infrastructure that we suggest to introduce for the loan process is actually electronic signature on top of an existing identity. And what that means is today electronic sort of digital signatures are captured using these dongles and USBs and things. Instead of having complicated routes or wet signatures, where I have to scribble and sign, many sheets of paper in order to indicate the acceptance, if you have a verifiable national identity, you can actually, as a layer on top of that, create an e-sign capability on top that allows me to sign any document digitally using that identity and a one-time password that's sent or any kind of authentication on top of that identity to actually confirm my signature onto a document. And this e-signature building block closes the loop in some sense on being able to complete a loan transaction. The additional or final sort of building block that you could explore if you've done all of this and you still want to take this work forward and accelerate even further is to solve for the cost of discovery of a loan. Now today what happens is each financial institution goes out and markets their financial products, and the only way to sort of know who has a good financial product for you is actually to go directly to the institution or to look at these aggregator, loan aggregator apps or communities which try to aggregate some of this information by going to each and then setting up their own listing and then matching you to the right loan product. And this is sort of a space that's full of information asymmetry again. So how do we create a process that is actually provides you the right information to take a decision on which loan might be the best terms for you and which offer might be the best for you? This is where we can introduce a digital public infrastructure for the discovery of a loan, which can be powered by the Beckon protocol, where essentially what you do is you standardize the mechanism in which different banks or institutions describe their financial products, and then you create open discovery of these financial products across a separate ecosystem of innovating apps that can seamlessly all see who has what kinds of products, right? And so the ability of this middleman ecosystem that's actually reaching out to the customer and trying to match the customer with the right loan, they all have equal visibility on who has which products. And so that's another ecosystem that can be thought through. But in our view, if you don't get these preliminary ones right, if you don't have a data sharing ecosystem, if you don't have a solid payment rails to actually disburse the loan and to auto take repayment for the loan, then the credit discovery is a bit of an overkill. So work towards the foundational blocks first to make sure the biggest costs, and the biggest cost is in the verification part, is actually tackled before you go for the next layer. This is our humble view, and we're happy to adjust this hypothesis based on a series of different country engagements. So if we actually had to summarize the final sort of set of blocks that you need, if I had to actually just condense all of what we talked about, right? If you think about the final step of the ecosystem you're trying to get to, the steps of sort of getting a loan maybe first might be KYC, right, to prove who you are. Then it might be sharing information, which is to say your bank statements, your asset information, and others. Then it might be sort of to actually see loan offers, which is to understand the discovery piece. Then you might actually select an offer and sign the contract once they're approved. Then you might actually get the loan disbursed, and then you would actually repay the loan, right? So if you think of these as the stages of completing a loan transaction, now you have to think through what are the building blocks that power all of these, and do all of these exist in my country? So for KYC, you might have a verifiable credential for individuals and for businesses, or you might have an API for auth and eKYC, right? And again, both of these are for both MSMEs, so businesses, and for individuals. Excuse my handwriting. You might have to share a bunch of information. In that sharing of information, you might have open finance, which means your APIs for sharing real-time bank statement information, tax invoices, and others. And you again might have verifiable credentials that allow you to prove your assets. So they might use verifiable credentials, let's say for land or home are the most common ones, right, that you would include. And these open finance APIs again would cover tax data, they would cover bank statements, and any others, right? In order to see the loan offers, you might have APIs for discovery, which is the beckon protocol I just mentioned. To select and sign, you might have an e-signature DPI, which allows you to sign the loan contract, right, and to actually go through. In order to disburse, you might have a payment rail, which is for P2P or P2M, right? In order to repay, you would have a building block on top of the payment rail for auto repayments, which gives banks sort of a sense of security that you're actually going to pay them back and might actually reduce interest rates, right? So all of these steps need all of this infrastructure behind them. Don't be daunted by this image. It can take 5 to 10 years for all this infrastructure to come to life. But the key thing in your country is to say, who has the unlock for each of these and where can we start? If you have maybe a really good land minister, a minister of land and that's actually driving a lot of progress, maybe you can start there. Please convert your land documents into verifiable credentials. If you have a really good central bank governor or a really good payment switch, maybe you can start with crafting the P2P payments rails or the open finance data sharing rails. If you have an excellent identity chairman, you can start by saying, can we pick a driver's license? Can we take one of these identity documents and generate them in verifiable form. Start where you are, but start and build these in a modular form. You don't have to have everyone agreeing on every block in this ecosystem, as long as the right provider of each building block has done the work to make their building block usable for a low-cost and highly affordable set of financial services or products. Thanks, everyone. Hope this was useful, and look forward to seeing the growth in financial services that you all engineer in your own countries.